Welcome to the deep dive. Today we are strapping in for a high-stakes, high-velocity analysis of one of the most critical financial reports to hit the wires this quarter.
We're talking about the unaudited Q3 2025 results for JD.com.
Exactly. And this deep dive is essential because what we're seeing is a company that's really operating with two different speeds.
Right.
One is this healthy, margin-improving efficiency.
Yeah.
And the other is just massive, aggressive investment.
It's the ultimate corporate paradox, isn't it? For you, the listener, you have to think of JD.com as, fundamentally a supply chain and technology service powerhouse.
Right.
And these Q3 results, they're basically a live case study in ecosystem warfare. Our mission is to just cut through the noise of all these complex financial tables.
And we really need to reconcile management's, upbeat assessment of user growth and core retail strength.
Which is real.
It is real, but you have to square that with the shocking decline in the group level consolidated profitability.
That tension is the whole story. The simultaneous success and, well, the financial sacrifice. That's our roadmap for this deep dive.
Yeah, we're synthesizing the official Q3 announcement, parsing the strategic intent that's kind of embedded in the quotes from CEO Sandy Zhu and CFO Ian Sushan.
And really connecting the dots between those revenue shifts and the explosions in expenses.
But ultimately, we have to figure out if this investment phase is sustainable or if JD is just running too fast and way too expensively.
The initial conflict is it's unavoidable. While the core retail engine is absolutely thriving, the strategic choice to just aggressively fund these new businesses,
It's eating the profits.
it's actively cannibalizing current profits. We need to follow that cash trail, and we have to do it meticulously. You're talking about billions of RMB being poured into expansion. It's a deliberate, high-risk play.
Okay, let's start at the very top then, the financial headlines. This is where that dual narrative really begins.
It is.
Because if you just look at the gross momentum, JD looks incredibly strong. It suggests their core market position is, almost unassailable.
That's completely right. The top line just paints this picture of robust health. Total net revenues for Q3 2025 hit RMB 299.1 billion.
Which is a huge number.
It's a huge number, and crucially, it reflects a very healthy year-on-year growth of 14.9% compared to the same quarter last year. I mean, in almost any other industry, that kind of double-digit growth is fantastic news.
But the key insight here isn't just the total number. It's what is growing, right? We need to pay close attention to the mix.
The mix between product sales and service sales.
Yes.
The whole strategic direction of the company is right there in plain sight.
So where's the momentum coming from?
It's being driven by the shift toward monetizing JD's infrastructure. Net service revenues, so that's things like marketplace commissions, marketing services, and logistics for external clients, they saw a massive jump.
How massive?
30.8% year-on-year. Now contrast that with the traditional core net product revenues, which grew at a steadier, though still respectable, 10.5%.
Okay, so that outperformance by the service segment, that confirms what JD's been trying to do for years. They're transitioning
Yes, from being just a retailer
to being a comprehensive retail as a service provider. I mean, they built this gigantic, efficient logistics network, and now they're just selling access to it.
and turning what was once a cost center into a high-growth revenue stream.
Right. And higher growth usually means higher margins, which is why that 30.8% figure is so exciting for the long term.
It is, but this is where that growth momentum just hits a brick wall when we look at profitability.
Right. And here we should probably quickly touch on the difference between GAAP and non-GAAP reporting, because JD's numbers, they look pretty stark either way you slice them.
Yeah, let's define that for everyone listening. GAAP is the standard accounting methodology, but companies often report non-GAAP because it strips out things like one-time charges, stock-based compensation.
Right. Things that management argues don't reflect the core business. They say it gives a clearer view of operations.
And in this case, neither number really offers much comfort, at least on the surface. On a U.S. GAAP basis, net income attributable to ordinary shareholders just plummeted.
It fell to RMB 5.3 billion in Q3 2025. And just for context, that's down from RMB 11.7 billion in Q3 2024.
That is a staggering fall, more than a 50% drop in reported profit.
And if you look at the non-GAAP numbers, is the story any different?
Not much better, no. Non-GAAP net income dropped from RMB 13.2 billion a year ago to just RMB 5.8 billion this quarter.
So the gap between GAAP and non-GAAP is pretty narrow.
Very narrow, which tells you this isn't some accounting trick. It's a genuine massive drop in operational profitability.
And if you translate that down to the shareholder level, the earnings per share.
That's where it really hurts. The diluted non-GAAP net income per ADS, or American Depositary Share, it fell from RMB 8.68 to just RMB 3.73.
Oof. That kind of dramatic compression in earnings is what drives market reaction. It really demands an explanation.
And the explanation is simple, even if the implications are, very complex. CFO Ian Sushan put it explicitly in the release. He said the consolidated bottom line performance reflects the investment in the new businesses.
That quote is our key. That's the whole thing right there.
It tells us two things. One, JD Retail, the core, must be healthy enough to completely mask or, fund this loss. And two, the loss itself must be truly monumental.
So we have to isolate that core engine.
We have to.
Okay, let's do that now. Let's turn the lens onto Section 3, JD Retail. This is the financial powerhouse, the source of the capital that's funding the future if this part wasn't working.
The whole ecosystem strategy would crumble, and JD Retail is absolutely the operational powerhouse. Its net revenues were RMB 250.6 billion.
Which is an 11.4% year-on-year increase. Solid growth.
Solid growth, but the real story, the really impressive part, is the operational efficiency improvement.
That's where we see the payoff from all those years of investment. The income from operations of JD Retail expanded to RMB 14.8 billion in Q3 2025.
And that's up significantly from RMB 11.6 billion in Q3 2024. That is an almost RMB 3 billion jump in operational profit from just the core business.
But the most crucial detail here has to be the margin improvement, right?
It is. The operating margin for the retail segment improved from 5.2% a year ago to 5.9% in Q3 2025. This isn't just about selling more things.
It's about selling them smarter. A 70 basis point improvement in operating margin on a base this large is, well, it's monumental.
It's a huge deal.
So why is this happening now? Is it just leverage of scale, or are there specific, tech drivers that are reducing the friction?
It's a combination, but it's leaning really heavily into technological leverage. JD has spent years integrating machine learning and AI into its procurement, its warehousing, its pricing algorithms.
Okay.
So that 5.9% margin reflects optimized inventory management. They're holding less stock for less time. It reflects better pricing strategies, so fewer markdowns.
And it also reflects the scaling of their marketplace business within retail, which just inherently carries higher margins than selling products directly.
Exactly. This margin expansion essentially rubber stamps the group's ability to go out and aggressively pursue expansion elsewhere.
Okay, so if the core is generating all this capital, what is it actually selling? We noted that growth shift earlier, but let's break down the product categories.
We're seeing a really clear acceleration in general merchandise. This includes all the high-frequency purchases like groceries, household goods, apparel.
And the revenue numbers there.
Revenues in that category grew by 18.8% year-on-year, reaching RMB 97.5 billion.
That rate of growth is so crucial for the long game. I mean, electronics are high value, but general merchandise is what drives user frequency, user stickiness.
Right.
And if management noted this growth further accelerated compared to the prior quarter, that tells me their efforts to capture the daily shopping basket are gaining critical mass. This is how they fight back against the hyperlocal competitor.
Exactly. They are moving into the weekly purchase cycle. If you go to JD just for your new phone or refrigerator, you might visit, 3 times a year?
Yep.
But if you start buying your cleaning supplies and your groceries there, you're on the app every single week. That constant engagement validates their entire supply chain model.
Meanwhile, their traditional stronghold, electronics and home appliances, showed steady but slower growth.
Yeah, up 4.9% year-on-year. That segment is still massive. It totals RMB 128.6 billion, but the growth rate reflects saturation and, frankly, a lot of competition.
And CEO Sandy Zhu mentioned a high trade-in base. What does that mean?
It just means the comparison period from Q3 2024 included a lot of really successful trade-in programs, which makes this year's growth tougher to achieve by comparison. But even at 4.9%, they are defending their leadership position in China's high-value goods sector.
Okay, now let's look at the strategic initiatives inside retail that are keeping this momentum going. It feels like JD is trying to own the entire commerce loop, moving from pure e-commerce to a true omni-channel integration.
The JD supermarket strategy is a perfect example of that. They announced 5 initiatives focused on products, brands, categories, channels, and efficiency for the next 3 years. This isn't just about selling more yogurt.
It's about leveraging their massive user insight data,
Precisely.
So how does that data leverage actually work in a supermarket strategy?
It's predictive retail. They can use these deep user insights, cross-referencing past purchases, demographics, search data to accurately predict gaps in the market.
And then what?
Then they collaborate with suppliers to improve product differentiation or even to launch products tailored specifically to what they perceive as a consumer need.
So the goal is to use their platform not just to sell existing products, but to actually create the next wave of bestsellers.
Exactly, and that moves them way up the value chain.
This collaboration must extend to their own brand efforts, too. The launch of JD Fashion seems like a great example of them trying to control quality assurance in a notoriously volatile market.
It is. The launch of the JD Fashion label on September 5th is a very specific vertical integration move. It signals to the consumer that these products, initially high-value things like wool products and down jackets, have undergone these really rigorous procurement and quality control checks.
And that builds trust, especially in fast fashion where quality can be, all over the place.
It builds trust, and it allows JD to capture higher margins on its own proprietary products.
And of course, the physical retail expansion continues with the JD malls. This has to be a massive capital undertaking.
It is, and it just demonstrates their commitment to these omni-channel experiences. JD Mall aims to be a one-stop shopping destination for home goods and appliances.
Allowing consumers to experience these tech-enabled lifestyles offline before they buy online.
Right, and they open new stores in major cities like Taiwan, Shenzhen, and Tianjin just in Q3.
How difficult is that operationally? I mean, to manage a large-scale physical mall presence while also maintaining the ruthless efficiency of their online supply chain.
The complexity is enormous. You're shifting from these centralized, automated distribution centers to decentralized, smaller inventory hubs that have to cater to immediate demand and also serve as showrooms.
Right.
Maintaining inventory visibility across, 20-plus JD malls and over 100 JD Appliance City flagship stores. It requires real-time data syncs, and that's where JD's proprietary technology is absolutely essential.
And they're trying to use the physical store not just for sales, but as a mini fulfillment center and a huge brand statement.
A very expensive brand statement. And this physical expansion isn't limited to the mainland either. We saw that announcement of the first JD Mall in Hong Kong.
That feels like a key step in regional internationalization.
It's a huge step. The strategic partnership with China Resources Longdation for the store in Wanchai, which is scheduled for 2026, is very important. Hong Kong consumers are sophisticated, they're high value, and they demand premier products.
So success there validates JD's brand and service standards for a global audience.
Exactly. It's a validation that goes beyond the scale they already dominate in the mainland. It's an expensive validation for sure, but a necessary one for global credibility.
Okay, so the core business is robust, it's efficient, and it's expanding both physically and digitally. Now, let's move to the other strategic pillars that are creating the ecosystem, but, aggressively demanding capital.
Logistics and health.
Let's start with Section 4, JD Logistics.
JD Logistics is the lifeblood of JD Retail, but it's also quickly becoming a global service provider in its own right. Revenue grew a very strong 24.1% year-on-year.
To what level?
To RMB 55.1 billion for the quarter. That shows exceptional adoption from external clients.
So once again, the margin tells the story of investment over immediate profit.
It does. The operating margin for logistics actually declined from 4.7% in Q3 2024 down to 2.3% in Q3 2025.
Wow, that's a big drop, over 200 basis points.
It is, and it confirms that they are consciously investing in expanding their network density and their global footprint. They are prioritizing long-term market share and superior service over short-term profitability.
And that investment is clearly visible in their Middle East expansion. Tell us about that Dubai warehouse launch.
The launch of the Dubai No. 5 warehouse on August 8th is a really concrete example of this investment. It's located in the strategically vital Jebel Ali Free Zone.
And this is their 9th one in the region.
9th high-standard overseas warehouse in the Middle East, yeah. It covers over 10,000 square meters. And the significance here is really twofold. First, the physical presence in a massive distribution hub.
And second,
it's catering primarily to a leading Chinese electronics firm.
Okay, that second point is vital. So JD isn't just serving its own e-commerce needs anymore.
Not at all. It's acting as the global logistics arm for other major Chinese exporters who are trying to navigate these complex Middle Eastern markets. That's a powerful new revenue stream.
It establishes JD as an essential partner for any Chinese enterprise looking for global reach. They're basically exporting their superior supply chain efficiency.
They are. And on top of that, they're doubling down on their air network capabilities.
Right, the new Shenzhen, Singapore, Tianji airport route. What's the strategic value there?
That new route, which uses a Boeing 737, it's all about speed and reliability for high-value goods. For things like cross-border e-commerce parcels, high-end electronics, waiting lists for sea freight is just not an option.
So JD is investing heavily to own and control that speed advantage.
And this isn't an isolated decision, it's part of a much larger plan.
Right, I saw it follows other routes they've opened.
Precisely. This new route follows existing full cargo routes like Wuxiantian and Shenzhen-Bangkok. By building this owned, integrated Asia-Pacific air logistics network, they minimize their reliance on external carriers.
Which means tighter security, faster transit times.
And crucially, reliable capacity. And that is a massive competitive moat in the volatile global shipping markets.
Okay, let's move on to JD Health, another massive, high-margin but high-investment vertical. It seems like they're shifting from being a general online pharmacy to something much more specialized.
That is the defining shift. JD Health is focusing on solidifying its position as the leading online marketplace for new and specialty medicine launches.
And that requires a completely different level of infrastructure and regulatory compliance than, selling vitamins and cough syrup.
A completely different universe. It means gaining the trust of global pharmaceutical giants. JD Health has these strategic cooperation agreements with major players like Eli Lilly, Innovent Biologics, Eisai China, Bayer China.
And those partnerships are the prerequisite for bringing these innovative specialized drugs directly to consumers online.
They are, and we saw specific examples of these complex drug debuts in Q3.
Like what?
Drugs like Eisai's Dayvigo, Hengrui Pharma's Hengkin for dry eye treatment, and even China's first special medical purpose formula for phenylketonuria, which is synthase Benju.
The logistical challenge there must be immense.
It's unbelievable. These often require strict cold chain management, specialized handling, and a really sophisticated system for verifying prescriptions and ensuring regulatory compliance. This is about building a true medical infrastructure, not just a retail platform.
And beyond the drugs, they are deeply integrating AI and smart devices into health management, the whole smart ecosystems play.
Yeah, the goal here is continuous, full-cycle, chronic disease management. In September, JD Health partnered with device brands like UL, Sinocare, and Microtech to create an intelligent, interconnected ecosystem alliance.
And their first focus is on what?
An integrated smart blood glucose management system.
A smart blood glucose management system sounds great, but how does JD's AI agent actually function within that? What does it do?
The AI agent acts like a personalized health companion. It processes continuous glucose monitoring data, it cross-references that with patient lifestyle inputs, and it provides real-time analysis, personalized intervention suggestions, and it tracks outcomes.
So it moves disease management from, say, episodic doctor visits to this continuous intelligent oversight.
Right, which can drastically improve patient compliance and health outcomes.
And the plan is to expand this to other major chronic conditions.
Absolutely. The Alliance intends to expand this full-cycle management system to blood pressure, ECG, and respiratory oxygenation. This positions JD Health as a vital piece of personal medical infrastructure.
It moves them beyond just transactional sales into recurring managed healthcare services.
And finally, we're seeing their tech move into traditional hospital settings.
The strategic cooperation with Union Hospital.
Yes, a major medical college affiliate. They're building a smart outpatient service platform, promoting the application of their JNO-C AI product right into offline hospital services.
So this is about streamlining the chaotic experience of a hospital visit, improving appointments, wait times.
And maybe even preliminary diagnosis triage. It's about applying their logistics and data optimization expertise to the medical process itself.
Okay, so we have the highly profitable retail core. We have the heavily investing logistics and health pillars. All three seem strategically sound, but none of this justifies the overall 50% profit implosion.
Not even close.
Unless we address the real swing factor, the segment responsible for all the pain.
Section V, the new businesses factor. This is where we have to confront the financial reality of ecosystem building. This segment, which houses JD Food Delivery, JD Property, Jinxie overseas businesses, it delivered a shocking set of numbers.
Let's start with the good news, though. The revenue growth was astronomical.
It was explosive. Revenue grew by 213.7% year-on-year in Q3, reaching RMB 15.6 billion. I mean, triple-digit growth is typically celebrated. It suggests they are aggressively capturing market share.
But the cost of capturing that market share is what just obliterated the consolidated profit.
Yes, this segment recorded a massive operating loss of RMB 15.7 billion for the quarter.
Wait, say that again? A loss of 15.7 billion on revenue of 15.6 billion.
That's right. To absorb that staggering loss, the operating margin for the new businesses segment was negative 100.9% in Q3 2025.
A negative 100.9% operating margin. That is a truly astounding figure. It means for every 100 RMB in revenue they generated, they spent over 200.
It's the clearest possible declaration that this segment is operating purely on a strategy of subsidized market share acquisition and infrastructure build-out. It is the definition of hyper-aggressive investment.
And when you compare that RMB 15.7 billion loss against the RMB 14.8 billion operating profit from the mighty JD Retail Corp,
you see exactly why the consolidated group net income just plummeted. The new businesses segment single-handedly erased the profitability of the entire enterprise.
But management did offer a subtle but critical caveat, specifically about JD Food Delivery, which has to be a major component of this cash burn.
They did. Management stated that JD Food Delivery continues to drive healthy progress and, crucially, that the overall quarterly investment narrowed sequentially.
Okay, that's the first signal that the most intense maximum burn phase might be transitioning.
It's a glimmer of hope.
So what does that sequential narrowing imply about their unit economics performance?
It means they're starting to learn from the scale. They're improving route density, optimizing driver incentives, and maybe reducing the size of the subsidies required to compete.
Right.
Unit economics refers to the profit or loss on a single order. If that loss per order is shrinking, even slightly, it indicates that enhanced operational efficiency and financial discipline are starting to kick in. They're trying to find the path to a sustainable service, even if they're not there yet.
And the strategic justification for this enormous expense hinges entirely on synergy with the core retail business.
Yeah.
Are they actually seeing signs of that yet?
Yes. Management emphasized that JD Food Delivery is actively generating those synergies. By bringing people onto the platform for highly frequent food purchases, they are driving user growth, increasing shopping frequency.
And most importantly, driving cross-category purchases.
Exactly. The food delivery users are now also buying items from the core JD retail catalog. So the high cost of acquiring a food delivery user is, in theory, amortized when that user also buys a washing machine.
And there's a quick note on the 7 Fresh Kitchen innovation. What's that about?
7 Fresh Kitchen focuses on providing higher quality prepared meal options. It's gaining recognition and maintaining a high average daily order volume.
So it's an important innovation because
Because it allows JD to control the food supply chain more deeply than traditional delivery platforms. It ensures quality control and could potentially lead to higher margins down the line. It's about supply chain innovation for food delivery, not just speed.
Okay, we've pinpointed the source of the profit compression. Now let's get into the deepest level of financial analysis, Section 6, to see exactly how that loss was incurred. We're talking costs, cash flow, and capital allocation.
If we look at the consolidated P&L, the overall operating margin just collapsed from a positive 4.6% in Q3 2024 to a negative 0.4% in Q3 2025.
That 500 basis point drop is the price of the strategy, and it's clearly reflected in 2 key expense lines.
The first one, the marketing expense line, is frankly astonishing. It just confirms this extreme user acquisition effort.
What's the number?
It's the headline figure that explains the negative 100% margin. Marketing expenses increased dramatically by 110.5% year-on-year. They surged from RMB 10.0 billion to RMB 21.1 billion for the quarter.
That's more than doubling your advertising and promotional budget in 12 months.
And management explicitly linked this massive jump to increased spending on promotional efforts for new business initiatives.
So the vast majority of that RMB 11 billion increase was spent acquiring users and building brand awareness for JD Food Delivery, Jinseki, and the overseas ventures.
Absolutely. As a percentage of net revenues, marketing costs went from 3.8% to 7.0%. That is a massive operational commitment that signals aggressive, expensive growth acceleration.
And while marketing is the most dramatic increase, fulfillment costs also saw a significant surge.
They did. Fulfillment expenses, so that's everything from warehousing and delivery personnel to customer service, they increased by 35.2% to RMB 22.0 billion.
This increase reflects the complexity of the expanding ecosystem.
It has to. They're not just handling large electronics boxes anymore. They're layering on hyperlocal, perishable, time-sensitive food delivery orders, which are inherently more expensive to fulfill per unit.
And as a percentage of revenue, fulfillment costs rose from 6.3% to 7.4%. This tells me the logistical complexity is genuinely increasing, and it's demanding higher investment.
In capabilities and in human capital, yes. We also saw R&D and general and administrative expenses both increase by roughly 28% year on year.
So it's not just superficial. They are building out technology and infrastructure company-wide to support a nearly 900,000-person ecosystem.
Exactly.
All this expenditure raises the critical question of liquidity and sustainability. Can JD afford this sustained burn? Let's look at their cash position and capital allocation.
The short answer is yes, they have the reserves. As of September 30th, 2025, JD's total cash equivalents, restricted cash, and short-term investments totaled RMB 210.5 billion.
Okay, so that is a massive war chest. It provides a deep cushion to fund years of strategic losses in the new businesses segment.
It does, and they're actively managing that capital in a way that signals management confidence. The share repurchase program is a very clear message to the market.
Strong vote of confidence.
Very strong. JD repurchased approximately 80.9 million shares for roughly $1.5 billion during the first 9 months of 2025.
And by buying back shares when the stock price is depressed, which it likely is, due to the short-term profit, drag management is signaling they believe the current valuation doesn't reflect the long-term intrinsic value.
It's a classic move. They're signaling faith in the core business and its future ecosystem dominance.
And they still have plenty of authorization left for that program, right?
Yes, the remaining capacity under the program, which runs through August 2027, is still US $3.5 billion. This means they are prepared to continue deploying capital to support the stock price while the strategic burn continues.
Okay, now we get to the core financial consequence of this strategy, free cash flow. This is the metric that shows the actual liquid cash being generated or consumed by the business.
And we need to carefully distinguish between the quarterly burn and the trailing 12 months or TTM trend.
Right, so FCF is what's left after capital expenditures. It's the cash they can actually use for dividends, buybacks, or new investments. What did it look like for the quarter?
For the third quarter itself, JD reported negative free cash flow of RMB 11.2 billion. Now, while that's negative, it was actually an improvement over the RMB 13.8 billion negative FCF they reported in Q3 2024.
So the quarterly burn is contracting slightly. That's a good short-term sign.
Yeah.
But the TTM figure must reveal the overall impact of the year-long spending spree.
This is the metric that truly quantifies the sacrifice. TTM free cash flow, the cash generated over the last 4 quarters, was RMB 12.6 billion.
Down from what?
Down massively from RMB 33.6 billion recorded for the previous TTM period.
Wow. An almost 2/3 reduction in free cash generation.
That is the clearest financial indicator of the scale and intensity of the new business's investment over the past year. They are rapidly drawing down their available liquidity.
We should also briefly touch on the changes in working capital. This can give us clues about operational strain or shifting business models.
Let's start with inventory turnover days. This is how long, on average, JD holds inventory before selling it. It increased from 30.4 days a year ago to 35.8 days.
An increase in turnover days often signals slower sales. But in this context, could it represent something else? Maybe a necessary evil of diversification?
I believe it's primarily a result of the changing product mix. When you expand aggressively into general merchandise, especially apparel and supermarket items, those products typically move slower than high-velocity electronics.
Okay, that makes sense.
So it suggests they are successfully stocking deeper in those new categories. But it comes at the cost of holding capital in inventory for 5 more days. It's an efficiency trade-off for strategic breadth.
And accounts receivable turnover days also increased.
Yes, from 5.8 days to 8.3 days. This means JD is waiting longer to collect payments. It could be due to more B2B services through JD Logistics, or maybe extending payment terms to external marketplace sellers to incentivize platform adoption.
So they're being a bit more generous with credit in their ecosystem to help it grow.
Right, which ties up capital temporarily.
Right.
But their accounts payable turnover days, the speed at which they pay their suppliers remains steady, so they're still managing their own payments consistently.
The overall financial picture is clear then. Fast reserves, aggressive capital, return to shareholders. But the cost of the strategic growth gamble has severely reduced their annual free cash generation.
It's the cost of empire building. They are deliberately sacrificing today's liquidity for tomorrow's dominance, and they're betting that the high frequency of the new businesses will eventually pay back tenfold in loyalty and cross-category sales on the core retail platform.
Which brings us to our final strategic context, Section 7, the sheer scale that JD is now operating at. These figures, I think, are the ultimate justification for their current expense strategy.
The human scale is almost unbelievable. As of September 30, 2025, the total personnel under the JD ecosystem, including employees, part-time staff, and affiliates, was approximately 900,000 people.
900,000 people. That makes them one of the world's largest private employers. And it ties directly into their deep, asset-heavy logistics and supply chain commitment. The human capital investment alone is immense.
And the customer acquisition efforts, funded by that skyrocketing RMB 21.1 billion marketing budget, are clearly working to drive massive scale.
What's the latest user number?
CEO Sandy Xu highlighted a critical milestone. The number of annual active customers surpassed 700 million in October 2025.
700 million users. That scale is the metric against which that negative 100.9% margin must be judged. They are turning cash into users at a rate that very few competitors can possibly match.
And the scale is now translating into enhanced global recognition. JD made the Fortune Global 500 list for the 10th consecutive year, climbing dramatically to number 44 in 2025.
And just 10 years ago, they were, what?
They were ranked number 366. That trajectory reflects a shift from a large domestic player to a global technology and service provider with continuously enhanced global competitiveness.
They're using their scale to attract international partners and talent.
They are.
So, synthesizing everything we've covered, from the 5.9% margin efficiency in retail to the launch of specialty drugs in Dubai warehouses, we see a highly strategic enterprise.
Yes. An enterprise operating in two distinct modes. You have a disciplined, high-margin, stabilizing core that serves as the treasury.
And then you have an unbridled, hyper-aggressive growth segment that is determined to capture the next trillion-dollar market segment, regardless of the immediate cost. And that strategic conflict brings us right back to the question we started with, the provocative thought we want to leave you, the listener, with.
JD is spending RMB 21.1 billion on marketing, an increase of 110.5%, predominantly to fuel ventures that are losing money at a rate greater than their revenue.
We know the goal is synergy and scale, reaching 700 million users and gaining access to high-frequency purchasing data.
So the question for you is, will this new businesses segment demonstrate sufficient, sustained sequential narrowing of its losses over the next, say, 12 to 18 months to satisfy the market that the strategy is actually working?
And specifically, does the strategic value of hitting 700 million users and securing that logistics footprint justify the current consumption of liquidity? Or, considering the two-thirds reduction in trailing 12-month free cash flow, will JD need to apply the brakes on investment sooner than planned to prove it can return to generating positive consolidated profitability without sacrificing the future ecosystem?
It's the ultimate test of patience versus profit, and JD has explicitly chosen future dominance. Whether the market and your portfolio can wait for that payoff remains to be seen.
Thank you for joining us for the deep dive into JD.com's Q3 2025 results. We'll catch you next time.